Energy prices, obviously, a driver of everything, whether it's groceries or filling your gas tank or whatever it might be, paying your electric bill. Energy prices, a big driver of inflation, always has been. It's not getting any better, it doesn't seem, from where I sit. What do you see?
No, I would agree. I mean, some of this has a correlation to what's going on in the U.S. dollar and other foreign currencies. But the bottom line is, oil got down into the low 60s, and then just 10 days ago it was at 85, and now it's hovering a little bit below 80. But anytime it gets to, what I guess you would say $80, it's a pretty significant tax on the U.S. economy.
Yeah, it is a tax on the U.S. economy. All right, so let's talk about some different things. I was talking to somebody yesterday who is in a position financially finally. You still with me? You with me?
Yep, I'm here. Sorry about that.
All right, so that's all right. I was talking to somebody yesterday who's in a position to buy a house, right? Had gone through a few things and looks at the interest rates and goes, I don't know that now is the time to buy a house. And I have to agree with her. Say, look, with mortgage rates, if you have a perfect credit score, your mortgage rates are above 7% now. I mean, this is a really troublesome thing for interest rates, isn't it?
Well, this is, Steve, what I've been kind of telling you, in your audience about for a while, is that we're getting to this phase now where the rubber's meeting the road in the economy. So we're seeing the impact of higher interest rates, and we're seeing Fed tightening right at the point where we're heading into a pretty serious recession. And yeah, it's going to be difficult. And the problem, Steve, right now is the Japanese have and the Chinese have a currency problem. Their currency is falling against the US dollar. So what they've been doing is dumping United States bonds in order to convert those bonds to cash so that they can go into the open market, take US dollars, and buy up their currency. So it's driving interest rates at the long end of the curve, which is where mortgages sit, even higher. And this is going to continue for a while. I'm concerned that the Japanese situation could create a more systemic problem.
Yeah. So when we look at those 30-year mortgage rates, I know you've got a couple of charts you want to share with the folks that are watching on TV today to kind of explain what's happening. Demand in China, a big real estate problem in China. We're having problems in America because of mortgage rates, like the person I talked to yesterday who would like to buy a home, who has the money for a down payment, who could get into a new home and says, why would I do that at 7, 8, 9%? What I don't know what her credit rating is, but you see my point. And meanwhile, Evergrande, this giant real estate company in China, in real trouble, which has a ripple effect globally, doesn't it?
Well, they filed for bankruptcy protection in the U.S., but they're one of, a number of giant, we'll call it development companies in China that are serious, that are having serious financial problems, can't make their interest payments. And so China has a big slowdown in demand. So much of their economy was based on, real estate development that ultimately turned into speculation. And now we're seeing the other side of that. But back to the Japanese situation, I think, Steve, where I'm going with this and why this is important to your friend who's thinking about buying a house is the conventional wisdom right now is that mortgage rates are going to be lower. And eventually they probably will be. But this could go on for longer than people think. So I wouldn't buy a house today with the idea that next year or in 18 months, you could arguably refinance. It might take longer than that. And by the way, interest rates could go a lot higher than they are right now. And even if the Fed decides to cut interest rates, they cut it at the short end of the curve. The market sets the long end. And so we could be in a situation where even though the short-term rates are near zero, you could still have long-term rates that are above, 6 or 7%. So it's a sticky situation.